Recessions strike fear into even the most seasoned investor, shaking confidence and testing patience. Markets tumble, headlines scream doom, and portfolios shrink seemingly overnight, leaving many unsure of what to do. But a recession doesn't have to destroy your wealth if you know how to prepare, protect, and position yourself strategically. Downturns aren't just about loss. They're about preparation, opportunity, and resilience. And the smartest investors know how to capitalize on both. Savvy investors don't panic. They stay calm while others make mistakes, turning uncertainty into advantage. They understand which assets weather storms and which strategies preserve capital, turning fear into foresight and maintaining long-term growth. Today, we'll reveal actionable steps to safeguard your portfolio during economic downturns and come out stronger on the other side. Because recessions are inevitable, but financial ruin is optional, and the right preparation can make all the difference. The difference between fear and confidence is a plan, and this video provides a complete one to navigate uncertainty. By the end, you'll know how to protect your investments, minimize losses, and seize opportunities even in extreme volatility. Whether you're a beginner or experienced investor, these strategies ensure your wealth stays strong, no matter what the market throws at you. Remember, a downturn is temporary, but your decisions today can shape decades of financial security and lasting prosperity. 1. Diversify across asset classes. Diversification is your first line of defense against market volatility, shielding your portfolio from massive losses and unexpected shocks. Don't put all your eggs in one basket. Spread investments across stocks, bonds, real estate, and cash to balance growth and safety. Each asset class reacts differently during downturns, reducing the overall impact of market swings and smoothing returns over time. Include defensive sectors such as utilities, healthcare, and consumer staples in your equity portfolio to provide stability and consistent performance during turbulent times. Bonds, high-quality fixed income assets, and other low-risk instruments act as cushions when equities fall, generating steady income and preserving capital for the long term. Diversification doesn't guarantee gains, but it significantly reduces risk, strengthens your portfolio's resilience, and positions you to survive and even thrive during recessions while capturing opportunities others might miss. 2. Increase cash reserves. Liquidity is a critical shield during uncertain economic periods, giving you the ability to act without panic. Holding cash or cash equivalents ensures you can cover emergencies without selling investments at a loss. It also provides dry powder to seize opportunities when quality assets are discounted and undervalued. High-yield savings accounts, money market funds, and short-term treasuries are excellent options to preserve value while keeping funds accessible. Aim for at least 6 months of living expenses and liquid assets to weather unexpected financial shocks with confidence. Cash may seem unexciting, but during a downturn, it's power, allowing you to stay calm, make informed decisions, and act strategically. Having liquidity reduces stress and prevents you from making rash decisions under market pressure. It allows you to take advantage of bargain opportunities when strong assets are temporarily undervalued. Cash also provides flexibility to pivot your investment strategy without being forced to liquidate at the wrong time. Building cash reserves gradually alongside your investments ensures stability while still allowing your portfolio to grow. Even a small, consistent allocation to liquid assets can make a huge difference in times of crisis. Liquidity acts as both shield and sword, protecting your wealth while enabling you to seize strategic opportunities. During a recession, having cash can also reduce reliance on debt, avoiding interest costs that can compound financial strain. Ultimately, maintaining strong cash reserves is not about hoarding. It's about preparation, control, and giving yourself a financial advantage when markets are volatile. Practice focus on quality investment. Not all companies survive a recession, but quality businesses endure, offering both safety and long-term growth potential. Invest in companies with strong balance sheets, consistent cash flow, and clear competitive advantages. Blue-chip stocks and dividend aristocrats often maintain value and provide income, even when markets are volatile. Avoid speculative or highly leveraged companies that are vulnerable to economic shocks, as these can wipe out gains quickly. Stable, reliable assets give your portfolio resilience and a solid foundation for growth over the long term. Think of your investments like armor. The stronger the fundamentals, the better they withstand economic storms and market turbulence. Quality investments often have the ability to adapt to changing market conditions, giving them a competitive edge. Companies with strong management teams and proven track records are more likely to weather downturns successfully. Focus on businesses that provide essential products or services as demand for these tends to remain steady even during recessions. Reinvesting dividends from these reliable companies can further compound your wealth over time. Holding quality investments reduces anxiety during market volatility because you know your portfolio is built to endure. Research and due diligence are key. Understanding the financial health and strategy of each company is crucial. Diversifying among multiple high-quality companies ensures that no single failure can derail your portfolio. Ultimately, focusing on quality isn't about chasing the highest short-term returns. It's about building wealth that survives and grows through economic cycles. 4. Consider defensive strategies. Defensive strategies act as an additional layer of protection against market swings and volatility. Options, inverse ETFs, and diversification across uncorrelated assets can reduce downside risk during turbulent times. Treasury securities and gold often rise in value during recessions, serving as safe havens and portfolio stabilizers. Rebalancing your portfolio ensures that your asset allocation remains aligned with your risk tolerance and long-term goals. Actively managing risk allows you to minimize losses without attempting to perfectly time the market. Strategic moves made today prevent panic-driven mistakes tomorrow, keeping your portfolio secure even in the harshest conditions. Hedging strategies like protective puts or covered calls can also provide targeted downside protection for specific holdings. Holding a portion of your portfolio in assets with low correlation to equities further reduces volatility. Diversifying across global markets can shield you from localized economic downturns. Review your defensive positions regularly to ensure they remain effective as market conditions change. Education and awareness are critical. Understanding how each strategy works ensures you deploy it effectively. Incorporating defensive measures isn't about avoiding growth. It's about preserving capital while maintaining opportunities for long-term gains. 5. Maintain a long-term mindset. Recessions are temporary, but panic-driven decisions can have permanent consequences for your wealth. Avoid selling investments out of fear. History consistently shows that markets recover and often surge after downturns. Focus on long-term goals, stay disciplined, and view market declines as opportunities to buy high-quality assets at discounts. Reinvest dividends, stick to your investment plan, and resist emotional reactions to short-term losses. Patience and consistency allow your portfolio to grow steadily despite volatility, rewarding disciplined investors over time. A calm, informed approach ensures that recessions become opportunities rather than setbacks, strengthening your financial future. Understand that compounding works best when uninterrupted, so staying invested is crucial for long-term growth. Ignore short-term noise, and daily market swings are irrelevant compared to decades of steady investing. Set realistic expectations and avoid chasing quick wins that increase risk and stress. Use downturns to reassess your strategy, refine asset allocation, and identify undervalued opportunities. Trust the process. Disciplined, long-term investing consistently outperforms reactionary decisions. By maintaining perspective and focus, you transform market volatility into a tool for wealth creation rather than a source of fear. Protecting your portfolio during a recession isn't about avoiding risk entirely. It's about managing it smartly. Diversify across asset classes, hold sufficient cash, focus on quality investments, use defensive strategies, and maintain discipline. Recessions come and go, but preparation and foresight compound wealth over decades. If this video helped you gain clarity, hit like, subscribe, and share it with someone navigating market uncertainty. Remember, downturns don't have to be destructive. They can lay the foundation for stronger, smarter investing. When others panic, prepared investors thrive, turning fear into opportunity and securing long-term financial independence.